Stock market investors are starting to get a little nervous. Now you might think it's because the Federal Reserve Bank says that our economy is shrinking, or it's because of concerns of tariffs or inflation, but that's not it. There's a very closely followed recession indicator which is now flashing warning signs. Let me explain. Wall Street creates these recession indicators as a way to predict when a recession could be coming. Sometimes these indicators are right and other times, well, they're early. But there's one particular recession indicator that the Federal Reserve Bank and economists and Wall Street all like to look at, which is called the inverted yield curve indicator. It has accurately predicted every recession since 1955 minus 1966 and 2022. Although the 2022 one is a little bit interesting because we did meet the technical definition of a recession, but it wasn't actually declared that we were in a recession. Now, to be clear, this inverted yield curve indicator is not a magic crystal ball. It can be wrong. But the way this indicator works is it measures when investors are moving away from short-term investments and moving into long-term investments, because generally that's a sign that investors are worried about the short-term health of the economy. Let me show you exactly what I mean, and I promise even if you don't have a finance background, if you stick with me, you'll know exactly what's going on. When you go to invest your money, you have a lot of options. You can invest your money in stocks, you can invest your money in real estate, you can invest your money in cryptocurrency, gold, startups, or bonds. A bond is a loan. And as an investor, one way that you can invest your money is by lending your money to other people or corporations or governments. Like you can lend your money to your broke cousin Bundy, but you might never see your money back. You can lend your money to a big corporation like Chipotle. This is called a corporate bond. Or you can lend your money to a government like the United States government. This is called a treasury. Now, just a little bit of background information. There are a few different types of treasury loans. There are treasury bonds, treasury notes, and treasury bills. They all mean essentially the same thing, except how long your loan is. A treasury bond is a loan you make to the United States government that's either 20 to 30 years long. A treasury note is a loan you make to the government that's somewhere in the range of a 2 to 10 year loan, and a treasury bill is a loan you make to the government for 1 year or less. But the important thing for you to understand is that all of these are treasuries, meaning loans that you make to the government, and the interest rate that you get on all of these loans are going to vary depending on supply and demand. So let's go a little bit deeper and let me show you why some economists believe that this can indicate when a recession is coming. If you have two investment options, option one is you lend the United States government money for 10 years, and option number two is you lend the United States government money for 3 months, where would you expect a higher rate of return? Well, normally the answer would be here, because if you're gonna lend your money to somebody for 10 years, that's a much longer period of time. A lot can happen in 10 years, and because you have to part ways with your money for so long, generally you would want a higher rate of return. But sometimes you see an inverted yield curve like we're seeing right now, which is where the interest rate that you get on this short-term loan, this 3-month loan, is higher than what you get here on this long-term loan, this 10-year loan. And the reason why this happens is because, again, the interest rate that you get paid is dependent on supply and demand. If there's not a lot of demand for this 3-month loan, the United States government has to attract more investors. They have to incentivize you to lend them money for 3 months. And the way they do that is by raising the interest rate. Well, if people are pulling their money away from these short-term loans and they're dumping them here into these long-term loans, and so you see these long-term loan rates start to fall because there's a lot of demand here. People are putting their money here, so supply and demand, the interest rate goes down because people keep lending. Well, they have to incentivize you to lend money here, and that drives this interest rate up. When you see that happen, this means that people are worried about the short term. They don't want to invest for 3 months, even if you're paying out these higher interest rates, and they're dumping that money into longer term investments because they're concerned about the short term health of the economy. This is what an inverted yield curve is. You're seeing higher interest rates on the short term treasuries as opposed to the longer term treasuries, and this is what we're seeing happen right now. Now, there's a lot of crazy things happening in our economy right now. And this is one of the reasons why on March 11th, I'm hosting a free workshop where I'll be going over the changes in our economy from Doge and tariffs and technology and the other Trump policies and how these things can create a new and unique investment opportunity. It's a free workshop and it's live. I'm doing it twice on March 11th, once in the morning at 10:30 a.m. Eastern Standard Time and again in the evening at 8 p.m. Eastern Standard Time. So if you want to join me, just make sure you register because we have a limited number of seats available and we have thousands of people that have already registered. So if you want to join, I have the link for you down in the description below. But the question again I want you to think about is why? Why are people moving their money away from these short-term investments into long-term investments? And this is where either people are worried about the data that we have, or they're worried about potential uncertainty. And it's a little bit of both. Like earlier in this video, I talked about how the Federal Reserve Bank is predicting a slower economic growth in the beginning part of 2025 because of changes in our economy. Well, at the same time, there's a lot of uncertainty out there. We have uncertainty with tariffs. We have uncertainty with reciprocal tariffs. We have uncertainty with Doge. We have uncertainty with technology. There's a lot of changes that are happening in our economy, and the stock market hates uncertainty. Well, all of those changes are creating a little bit of fear in the stock market. You've seen it with stock prices. You've seen it with cryptocurrency prices. That fear now has people concerned of, is my money safe in the stock market? And so that's when you start to see people try to be a little bit more cautious. They start to look for more hedges or more diversification as a way to potentially protect their money. Now, here's the reality, that if there's anything you get from this video, I want you to understand this. A recession is 100% coming. It's not a matter of if, it's a matter of when. Recessions happen, period. They are a part of our economic system, period. Recessions have happened in the past, and they will continue to happen in the future, period. The reason why I emphasize this is because nobody knows when the recession is going to happen. I mean, we don't know if we're going to see a recession in 2025 or 2030, but we know that a recession will happen. And the reality is, when that next recession happens, some people are going to get extremely rich, but the majority of people are going to complain, are going to get hurt, they're going to get burnt financially, and they're going to be blindsided when it happens. We have seen 16 recessions over the last 100 years. We are averaging more than one recession per decade. Well, the longest period over the last 100 years that we have seen without a recession was between the 2008 financial crisis and the 2020 pandemic, and the 2020 pandemic recession was a forced recession because our economy was shut down. We kind of saw a minor economic slowdown in 2022, but it wasn't actually declared to be a recession, but it wasn't a very painful recession. And the thing that I want you to understand here is you don't need to panic, you don't need to freak out, but you have to understand our economy. A lot of people want to sell hype. A lot of people want to sell emotion. A lot of people want to get you to feel this emotion, this intense emotion, because that's what gets you to click. But emotions are the enemy of profits. And what every financially savvy investor understands is, yes, a recession will happen. You cannot predict when the recession will happen, which is why Warren Buffett says time in the market beats time in the market. If you can perfectly time the market, you're going to make a lot of money. If you can buy at the bottom, you're going to make a lot of money. But nobody knows when that is going to happen. No one knows when the downturn is going to happen. No one knows when we're going to see that flip. I mean, markets could start booming tomorrow. The Federal Reserve Bank could change their monetary policy tomorrow. We could start a war tomorrow. A lot of things can happen that are out of our control. But you want to be able to win no matter what's happening. And that means, number one, having a strategy to invest your money, and then number two, having money put aside to capitalize on those opportunities when they happen. You want to have a strategy where you're consistently investing your money. Maybe you're a passive investor and you're just ABB, always be buying into the stock market. You're just buying the S&P 500. Maybe you're looking for more market shifts. These are the things that we cover in my Briefs Media company with our investor research. You're looking for shifts in the economy. You're looking for more unique opportunities. Great. But you also want to have a system for your money. That way, you always have money put aside to protect you against an emergency, but also to be able to capitalize on investment opportunities that come your way. I don't say this to brag, but some of my best investments of all time were made during the 2022 downturn, the 2020 downturn, and the 2008 financial crisis, around the 2011-2012 time. Yes, these were very painful periods for a lot of people, but I was very fortunate to be able to be investing during the time, and I was able to buy very good investments for pennies on the dollar in some instances. Now, that doesn't mean that I'm not investing when markets are up. I mean, I'm investing in 2025, I was investing in 2024, I was investing in 2023, I was investing in 2022, I was investing in 2021 and 2020. But you have to have that strategy for you. You have to understand the game. Wall Street gets this. This is why they keep getting richer, whether it's a recession or it's an economic boom. The average person is trying to find the perfect opportunity of how can I get rich quick without any risk. Well, there's always going to be risk, but you need to know how you can invest your money and continue to build wealth when things are going up, when things are going down, and when things are sideways. That means you have to have an investing strategy while being smart with your money, so you have money put aside. That way when, not if, but when things go down, you don't panic, you don't freak out. You understand this is the opportunity time, and now you can start deploying the extra money that you have. But it starts with you building your financial education, starting to understand how to do that research, and then capitalizing on the opportunities that you see come your way. It's not easy, but it is possible. Again, this is what I'm going over on my workshop on March 11th. I'm going to be going over what's happening right now and how you can take advantage of these opportunities. It's free. If you have not registered yet, I got that link for you down in the description. President Trump is now considering getting rid of the income tax. Take a listen.
As I said in my speech last week, instead of taxing our citizens to enrich foreign nations, we should be tariffing and taxing foreign nations to enrich our citizens.
The Fair Tax Act of 2025 was a bill proposed which would effectively abolish the IRS.